Welcome to lecture 24 of financial risk management, and in this lecture we are going to discuss some banking regulations. Mainly our focus would be on Basel Accord, and there are different aspects of Basel Accord, different risks that it would cover, and we will try to unfold those risks as we go through Basel Accord. So moving towards the contents, first we are going to understand what banking regulation are and what are the reasons for banking regulations that are imposed by different countries. Then we are going to understand what is adverse selection, moral hazard, and information asymmetry. Basically, information asymmetry leads to moral hazards or adverse selection. And then we are going to have an introduction to Basel Accord. And further lectures down the road, we would understand different measures that are introduced in Basel Accord, different regulations that are there. Okay, so starting with the reasons of banking regulation. Why do we need banking regulation? We need banking regulation so that we can ensure that banks keep enough capital for the risk it takes. Bank borrow money and then they lend it, right? So where is the risk here? While lending the money, they charge higher interest from the party that has less credit worthiness and lower interest from the party with good credit rating, right? So bank have higher incentive, they have higher return if they lend the money to a party that would pay a higher return, right? One reason is this one. Second, they would try to keep lesser capital with themselves and would try to lend all the money as they have received from the deposits. But not keeping enough capital with themselves have consequences attached to it, and that is even both lending to a risky party. What would happen if the risky party starts to default, right? When the risky parties would start to default, the bank wouldn't have the capital to absorb that risk, and they would take that toll on themselves, and that would be passed on to the depositors. They might default on the depositors. If the depositors demand the money from the bank, banks might not be able to honor that call. So, and if one bank start to fail, then the whole system collapses. The whole banking system would collapse because the confidence of the depositors would be shattered. So what government wants is to keep this confidence in the banking system intact, and that's why they introduce banking regulations, because these regulations would ensure that the banks do not take higher risk or the risk that they cannot absorb. That would make the probability of their failure lesser. There would be lesser chances that they would fail. It would enhance the confidence of the public on the banking system. And remember, if a large bank fails, that would lead to a failure of whole banking system or the whole financial system, and that's what we saw in the financial crisis of 2008-9. What happened in 2008-9 is that banks were involved in riskier businesses, the CDOs, etc. That is a topic that we would discuss in some other video. So, due to that, what happened is that certain banks were at the verge of collapse, and Lehman Brothers went bankrupt. So when one bank goes bankrupt, what happens is that in general public there is a fear that the other banks might also go bankrupt, and there is a run on the bank. The people starts to take their deposits out of the bank, and once that starts to happen, then the financial system would not hold that, because obviously bank have lended that money to someone else, and they cannot honor all the calls of all the depositors, right, at the same time. So the government knows that they cannot eliminate the risk altogether, and that is not possible, but the government wants to make the probability lesser. By doing this, they hope to create a stable economic environment where private individuals and businesses have confidence in the banking system. So, okay. So we have discussed why banks need to hold capital. Remember, when the start of this risk subject, financial risk subject, we discussed different strategies. We can hedge the risk, we can insure the risk, or we can hold capital to absorb the shocks, the risks, right? So obviously banks do perform other strategies, but they also need to hold some capital for them to be able to absorb the risk. So to ensure the soundness of banks, the regulators specify minimum capital ratio that banks need to maintain. That is, they need to have some capital, some owner's equity that should be there. So if banks are not regulated, what will be the tendency of banks towards capital to asset ratio? What would they do is they would hold a lesser capital to asset ratio. By the way, for banks, the assets are their loans, the loans that they have lended. So one question that might arise in your minds is that why not deposit insurances? I mean, what banks can do is that whatever deposits they have, they can insure those deposits, right? And if bank fails, I mean, what the country can do, what the banking regulators can do, they can ask the banks, they can make it obligatory on the banks to have deposit insurance. And in deposit insurance, if a bank fails, the insurance company would repay the deposits to the depositors, right? To the customers of the bank. And that might solve the problem, right? But there is an issue in it. And that issue is that deposit insurance create a new issue which is called moral hazard. And what moral hazard is, we will discuss in the next slide. Again, for the solution of moral hazards, bank should be required by the apex authority to maintain enough capital, right? So this deposit insurance would solve one issue, but it would create the issue of moral hazard, and for that moral hazard, they would again have to hold some capital, right? So the idea is that deposit insurance might work to some extent, but they are not the solution. And what would happen if there are deposit insurances? Okay, first we will discuss moral hazard, and then we will be able to understand if there is deposit insurance, how that moral hazard would be created. Okay, moral hazard is the risk that the party to a transaction has not entered into a good faith. And this moral hazard basically stems for another issue, which is called information asymmetry. What information asymmetry is that in the transaction, the two parties, party A and party B, do not have the same amount of information. So when both the parties do not have the same amount of information, then there is a chance that one party with the higher information may exploit the party with the lesser information, right? Okay, so by the way, information asymmetry is, in a nutshell, it is the idea that in economic transaction, two parties do not have the same amount of And when there is information asymmetry, that leads to moral hazards. And what moral hazard is in nutshell is that after the transaction, remember moral hazard would occur after the transaction has happened, that after the transaction, one party may be incentivized, may have an incentive to change his behavior or to take to be immoral, right? For example, let's take an example of car insurance. In car insurance, what happens is that, let's say there is Mr. Akbar who takes who enters into a car insurance. Now although Mr. Akbar is a careful driver, he drives cautiously, but after taking car insurance, he knows that the risk of the damage had been transferred from Akbar to the insurance company. So what Akbar would do is he would drive carelessly, right? And this had happened, this careless behavior had happened after the transaction had occurred. So what this transaction did is that it changed the behavior of Akbar to be careless, right? Let me give you another example, and that example is from the previous case of deposit insurance. When the bank would have a deposit insurance, what the bank would do is they know that their deposits are insured, the risk had been transferred to the insurance company. Now they would take higher risk, even higher risks. So in essence, the insurance, the deposit insurance didn't solve the previous problem, but it created a new one. So this is what explains this. In moral hazard, a party has an incentive to take unusual risk in a desperate attempt to earn profit before the contract settles. So this is what explains the logic behind the moral hazard. One more issue that information asymmetry creates other than moral hazard, and they go side by side, is adverse selection. So whenever we discuss moral hazard, there is also a discussion over the adverse selection, and what adverse selection as opposed to moral hazard, it happens before the transaction. Remember, moral hazard happens after the transaction had happened, but adverse selection happens before the transaction. And again, it is related to information asymmetry when one party has better information over the another party. Now, let's again discuss the example of the car. Example is, say, in this case, John is a reckless driver, right? He is a careless driver. He knows he is a careless driver. He goes to an insurance company for an insurance. He tells them that he is a careful driver. He haven't got any ticket for last few months, and so he satisfied the insurance company that he's a careful driver, right? He isn't reckless. So now once John gets the insurance, and why did he went for the insurance at the first place? Because he knew he would have an accident soon, right? One day or another. So what this happened is that once John would have an accident, the cost would be bared by the insurance company, and another person, Akbar, who although is a careful driver, would have to pay a higher cost because of John. And once that happened, Akbar would like not to have an insurance for his car. So at the end of the day, insurance company would be left with the people who are careless and they are high risk takers. They are like John. So Akbar's would be out of the equation and John's would be there. So anyhow, what the idea of adverse selection is that it is a situation where the party who should not be selected is selected, right? So when a party that the insurance company do not want to select, which is John, because he is a high risk driver, he is a loss for the insurance company. Insurance company wants to have more Akbars than Johns. So insurance company do not want to select John, they want Akbar. But because John knows that he have a bad record, he would try to cover that up and he would make more efforts to be selected. So because of those efforts, there is more likely that John would be selected for the insurance. And if John is selected, that is what we call adverse selection, because insurance didn't want it, John, and he's been selected, right? In a nutshell, the company, the person who should not be selected is selected, right? The same is the case in borrowers. The borrowers who have a bad credit record, would make more efforts to be chosen than the good parties, and because of those efforts, they would be chosen. So this is what adverse selection is. Now, these adverse selection and moral hazard would create the issue that we discussed previously. So we know that there is a need for banking regulation, but the main banking regulation didn't occur till 1988. So we are going to discuss what was the banking regulation pre-1988. So prior to 1988, bank regulator within a country tend to regulate bank's capital by setting minimum level of ratio of capital to total asset. So there was this ratio, this minimum capital requirements, but those ratios or minimum capital requirements were different from one country to another country. So some countries would enforce more strict regulations on their banks, and others would impose lenient restrictions on their banks. So the countries that imposed more stricter restrictions of capital requirement, that country's banks were at disadvantage with their international competitors, right? So there was a need for a more sophisticated approach than just a minimum level, right? Another issue is that, as compared to the issue that we just discussed of the regulation of different countries, another issue is that minimum level is one aspect. There is more aspects that need to be there in banking regulations, and that was missing. So a Basel Committee was formed in 1974, and they presented their first document in 1988, which was the International Convergence of Capital Measurement and Capital Standard. This was the title of the document. Later on, it was referred to as a BIS Accord, or simply the Accord, or after Basel II, we know it as Basel I. So we have different accords, different regulations. First was issued in 1988, which is called Basel I, right? You need to remember this. This Basel I was issued in 1988. By the way, Basel is a city in Switzerland. So this convention happened there, so that's why it got its name as Basel. This accord happened in Basel. Okay, so the Basel I was introduced in 1988. Later on in 2001, Basel II was introduced. It had more sophisticated mechanism, and after the crash of 2009, probably in 10 or 11, the Basel Accord 3 was introduced. So Basel Accords are three sets of banking regulations: Basel I, Basel II, and Basel III, that are introduced by BCBS, that stands for Basel Committee on Banking Supervision. Remember, this Basel Committee on Banking Supervision was formed in 1974. It provides recommendations on banking regulations related to credit risk, market risk, operational risk, liquidity risk, and leverage risk. By the way, the first Basel Accord only covered the credit risk. Later on in Basel II, or the amendments that happened in Basel I, the market risk, and later in Basel II, operational risk was also introduced. And in Basel III, the liquidity and leverage risk was also introduced. It ensures the financial institutions have enough capital on account to meet obligations and absorb unexpected losses. BCBS was founded in 1974 and consisted of central banks from different countries. In start, it was the central bankers from 27 countries of the European Union. So, this was the introduction of Basel Accord and the need for banking regulation. In next video, we are going to understand Basel Accord 1, and we are going to see how credit adequacy ratio is, or Cook ratio is calculated.